All right, let's dive right into this explainer and systematically demystify the complex, escalating mechanics of the hidden economy. Today, we're not just listing off dry facts, we're going on a real journey of discovery to see exactly how dirty money gets cleaned layer by layer. We're going to start right at the street corner and scale all the way up to the absolute highest echelons of global finance. It is a fascinating, highly structured escalation, and honestly, understanding how it actually works, it completely changes how you view the entire global financial system.
Picture this. You're holding a duffel bag stuffed with cash, say 18 grand. Your very first instinct is probably the exact trap that catches most people. You think, I'll just avoid the bank's automatic reporting threshold, right? Because anything over $10,000 triggers a currency transaction report, or CTR. So you decide to split it up into smaller chunks. But man, that instinct to hide the money, that is exactly how the trap snaps shut.
To unpack how this all works, here is our roadmap. We'll start with Main Street money laundering, then look at paper companies and real estate. From there, it's global trade and crypto mixers, the banking system blind spot, the human weak point, and finally, how dirty money unravels.
Okay, part 1. Main Street money laundering, from duffel bags to laundromats. Let's start small and see how this builds, beginning with the simplest and honestly the most easily caught methods at the street level.
So, that initial urge to split up your 18 grand? There's a name for that. It's called structuring. And here is the kicker. Structuring your deposits is a federal crime all by itself. It literally doesn't matter where the cash came from. You could be depositing entirely legal, legitimate money, but the deliberate act of breaking it apart just to dodge that $10,000 form? Yeah, that is strictly illegal.
And here is the real Achilles heel. Banks aren't just sitting there staring at that $10,000 line. They've got automated compliance software instantly flagging suspicious patterns just under the limit. So you drop off $9,900 on Tuesday and then $8,100 on Wednesday across town. You are not outsmarting anyone. Tellers and algorithms are hunting for these exact clusters. They don't even need hard proof of a crime to file a suspicious activity report, or SAR. The pattern just has to look a little evasive. And boom, just like that, the street-level launderer is caught.
Now, let's step it up a notch. Say you actually survive the structuring phase. Your next move? You might buy a cash-heavy business. To legitimize those funds, think laundromats, car washes, maybe a nail salon. You basically mix your dirty cash right in with the legitimate everyday earnings. If the laundromat makes $4,000, you tell the government it made $6,000, and that extra $2,000 of dirty cash rides along disguised as totally normal revenue. You are willingly paying extra taxes on fake income, which sounds completely crazy until you realize it's just a small business expense to get that illegal money into the bank legally.
But wait, here's the catch. And it's a big one. You can fudge the numbers on paper, but you literally cannot fake physical reality. An auditor isn't just looking at your spreadsheet. They can simply check your utility bills. Try explaining to the IRS why your supposed mega laundromat barely uses enough water and detergent to wash a few pairs of socks. They check your water usage, your electricity, your physical supplies, and compare it to your sky-high revenue claims. The math? It just doesn't add up.
Moving right along to part 2, paper companies and real estate. We're talking layering and subjective value here. Because there's only so much water one storefront can realistically use, you have to scale up to entities that don't rely on walk-in customers to explain their income.
Enter shell companies. These things exist entirely on paper, churning out fake invoices for vague stuff like consulting that never actually happened. But investigators, they don't get hung up on a single isolated fake invoice. They are hunting for structural fingerprints. They look for the connective tissue tying dozens of these shady companies together. Are they all using the exact same registered mailbox service, the exact same specialized accountant, the same formation agent? Finding that hidden network turns a vague hunch into a rock-solid, prosecutable case.
And this perfectly highlights the incredible power of real estate. Check this out. You buy a rundown property for $200,000. A year later, you sell it to your own shell company for $500,000. Just like that, you pocket $300,000 of seemingly squeaky clean profit. How? Because property valuation isn't an exact science. It is totally subjective. If the market shifts even a tiny bit, where you claim you made some renovations, you've suddenly got all the cover you need to legitimize hundreds of thousands of dollars in a single transaction, totally bypassing those cash deposit flags.
All right, on to part 3, global trade and crypto mixers. This is where we get into hiding in plain sight and digital pools. Eventually, domestic methods hit an information sharing ceiling. The banks, tax authorities, property records, they all talk to each other. So to really scale further, the money has to cross borders and go digital. That leads us straight into offshore structures.
Layering money globally through offshore jurisdictions is a classic move because it works so incredibly well. You bounce money from a shell company in one country to a trust in another, specifically picking places with super weak ownership laws. It's meant to be an absolute jurisdictional nightmare for investigators. That is, until a massive journalistic document leak drops exposing the shared formation agents and entire client lists overnight. Suddenly, investigators aren't just tracing one transaction, they're looking at the master key of who truly owns what.
Another massive loophole? Trade-based laundering. It's literally hiding in plain sight within everyday global shipping. Let's say you ship a container of ordinary furniture, but you over-invoice it. The receiving company pays the massively inflated price, and that extra chunk of cash, that is your dirty money crossing the border. Or you flip it and under-invoice, letting the receiver sell the goods at full price and pocket the laundered difference. It is insanely hard to detect. Why? Because customs agencies are built to catch smugglers sneaking in contraband, right? They aren't set up to independently verify if the invoice price of an office chair perfectly matches current global market rates.
Now, when we shift to digital funds, launderers try to snap that direct money trail using cryptocurrency mixing services, also known as tumblers. The process is pretty straightforward. Your dirty crypto goes into a massive digital pool, gets completely functionally mixed around with everyone else's funds, and an equivalent amount gets spit back out to a brand new, seemingly unconnected wallet address. It's essentially the digital equivalent of tossing a marked bill into a blender and pulling out a fresh one. Alternatively, they just exploit the gaps, moving funds from heavily regulated exchanges to ones with virtually zero oversight.
But wow, the irony of crypto laundering is just incredible. The whole promise of digital anonymity, it's completely temporary. Because the blockchain is a permanent, publicly visible ledger, a single seized mixer can expose years of history in one fell swoop. The moment law enforcement seizes that mixer server and grabs the logs, the gig is up. Because that public ledger records everything permanently, investigators can retroactively unmix every single transaction you thought was buried forever.
Which brings us to part 4, the banking system blind spot, or as I like to call it, institutional failure. At the absolute peak of the ladder, we enter the world of billion-dollar laundering, where individual transactions just vanish into the massive, swirling network of global finance.
When billions move through correspondent banking, which is just banks processing transactions for other foreign banks, it's almost never some grand cinematic conspiracy with evil executives in a smoke-filled room. Honestly, it is just slow, boring institutional failure. You've got compliance teams that are completely under-resourced, drowning in thousands of automated alerts every single day, add in bonus structures that literally reward people for pushing through high transaction volumes, and lucrative foreign banking relationships that are just deemed way too profitable to heavily scrutinize. The result? They just stop asking the obvious questions.
Now for part 5, the human weak point, the ultimate motivator. Despite all these insanely complex layers, offshore trusts, and digital shields, the entire system hinges on one deeply flawed component that breaks time and time again: the human element. There's a great quote from our source, but really hits the nail on the head. Behind almost every major laundering prosecution, there's a person, not just a paper trail. You can build a system that survives forensic audits, from structuring all the way up to correspondent banking, but it almost never survives a single motivated insider, an accountant who kept a secret ledger, a compliance officer who got passed over for a promotion. Once they realize their massive whistleblower rewards on the table, these networks get cracked wide open from the inside out, simply because someone sitting in the room finally decided to speak up.
And finally, part 6, how dirty money unravels. Let's look at the big picture and see how the perfect crime actually crumbles under its own weight. At the end of the day, money has to explain itself to some institution. Financial intelligence units, like FinCEN here in the US, slowly start scooping up these seemingly isolated data points from all over the world. They cross-reference thousands of currency transaction reports, suspicious activity reports, and cross-border wire data. So an invoice that looks totally fine in isolation, it suddenly looks incredibly guilty when matched against 40 other flagged transactions across 5 different countries. They use this massive data aggregation to reveal a structure that was literally there the whole time.
And honestly, this is the ultimate paradox of the whole thing. The system fails because every single layer of disguise the launderer adds actually works against them. Every shell company, every offshore trust, every crypto tumbler. Ironically, they just multiply the permanent data points left behind for investigators. They think they're hiding the money, but really, they're just drawing a longer, more complicated, but completely permanent straight line, connecting the original crime directly to where the money ended up.
So I want to leave you with this to ponder. As technology makes aggregating all this data faster, cheaper, and infinitely more comprehensive, is the era of hidden money actually coming to an end? If every single step you take to hide dirty money just creates an indestructible digital footprint, eventually laundering doesn't hide the crime at all, it merely documents it.
Thanks so much for joining me for this explainer, and I really hope it completely changed how you look at the mechanics of the hidden economy.